Hey, what's going on, ladies and gentlemen? This is Madison Rich, and this is UCC Talk 24. And here, we're all about the UCC, public and private rights, and giving people information and education to enrich themselves. So, in my last video, I talked about Cestui trust, right? And the benefits of creating a trust. Okay, so basically, I'm just gonna give you a little information on the tax liabilities that you have to pay when you create a trust. Okay, so that's what we're going to get into today. Okay, so basically, I recommend a strategy to create that $1 million trust fund. First, you establish a trust. Okay. Then you get the insurance policy, and you open the insurance policy up in the body of the trust. Okay. Perfecting your security interests by asking your provider to put the beneficiary down as the sole loss payee on the policy, so you can perfect your security interests. Then I would create a business, some type of business. Okay. Open up a business credit line, and when you apply for a credit line, you attach the insurance policy to your credit line, to your business credit line, because you can now use your policy as collateral for loans and business credit now. So you see the position that you're in now. So basically, it's like you create your own bank for your business that you can get funds off of. Okay, so that's a very powerful method, because a lot of people talk about secured party creditors and things like that, and what you can do as far as securing interest in the strawman or the Cestui trust held by the Federal Reserve. You understand? But technically, you want to be in a position of control, not ownership, because with ownership comes more liability. You understand? So you want to control the straw man and access the funds for the straw man. You understand? So there's really no need to really even get into the paperwork aspect of trying to secure that Cestui trust, because you'll bust your head. What you do is you just do the same process that the Federal Reserve did when you were born, and opened up bonds and used your birth certificate as collateral, right, and pledged your future labor, right, as collateral. Okay. So that's something you guys have to look into before you go messing with those Cestui trusts. Okay. So I just basically gave you the game right there. Okay. So we're gonna get into this right here so you understand how this thing is working. Okay. Okay. Estate and trust income. And estate or trust, unlike a partnership, may have to pay federal income tax. If you're a beneficiary of an estate or trust, you may be taxed on your share of its income distributed or required to be distributed to you. However, there is never a double tax. Estates and trusts file their returns on Form 1041, and your share of the income is reported to you on Schedule K-1, Form 1041. Okay. So basically, your trustee is gonna file and report your income distributed from the trust, right? If it's a statutory trust in the public, on Form 1041. Okay, and then you get a Schedule K 1041 cooperating on the distribution of the income from the trust. Okay, so that's how that works. So you never tax twice. Okay, current income required to be distributed. If you're the beneficiary of an estate or trust, that may distribute all of its current income, you may report your share of the distributable net income, whether or not you actually received it. Current income not required to be distributed. If you're the beneficiary of an estate or trust and the fiduciary has the choice of whether to distribute all or part of the income, you must report all income that is required to be distributed to you, whether or not it's actually distributed, plus all other amounts actually paid or credited to you up to the amount of your share of distributable net income. How to report. Treat each item of income the same way that the estate or trust would treat it. For example, if a trust dividend income is distributed to you, you report the distribution as dividend income on your return. The same rule applies to distributions of tax-exempt interest and capital gains. The fiduciary of the estate or trust must tell you the type of items making up your share of the estate or trust income and any credits you're allowed on your individual tax return. Losses of estates and trusts generally aren't deductible by the beneficiaries. Ain't that something, huh? Grantor trust. Income earned by a grantor trust is taxable to the grantor, right? Not the beneficiary. If the grantor keeps certain control over the trust, the grantor is the one who transfers property to the trust. This rule applies if the property or income from the property put into the trust will or may be returned to the grantor or the grantor's spouse. Generally, a trust is the grantor's trust if the grantor has a provisionary interest value at the date of transfer at more than 5% of the value of transferred property or has certain other powers. Okay? So that's something you guys need to look up to, look into, as far as your trust tax liability. You understand? So it's definitely something. That's the reason why I like to keep my trust in a private. All right. So you don't have to disclose certain information. You understand? There's something else. Remember, I was telling you that you could put your insurance policy up as collateral, right, for a loan or business credit. So I'm going to read this too: the credit card insurance. In most cases, if you receive benefits under a credit card disability or unemployment insurance plan, the benefits are taxable to you. These plans make the minimum monthly payment on your credit card account if you can't make the payment due to injury, illness, disability, or unemployment. Report on Schedule 1, 1041, line 8Z, the amount of benefits you received during the year that is more than the amount of the payments you paid during the year. Okay? That's something you guys need to look into when you're dealing with these trust instruments. Okay, I just want to give you a quick rundown, just showing you the tax side of trust when you create a trust. Okay, so that's very important to know. You can get a whole life insurance policy for you and your whole family. All right, and the value of all those policies, the totality opened up in the trust can become your banking source, right, for funds and business credit to enrich yourself and get the things that you need and want in life. Okay, so this is Bitch Talk 24. Excuse me, I'm sorry. This is UCC Talk 24, and I'm Madison Rich, and we will be back with more videos. Please like and subscribe if you have gotten value out of this video.